Today we're going to be looking at the smart money trading strategy, so let's get straight to it. Hey trader devs, I hope you're all going extremely well. My name is David and welcome to my channel where I go through trading strategies that I find on the web and YouTube, and then I use code to debunk the bad ones and find the good ones. Today we're going to be looking at something completely different, and this is going to be a series of a couple of videos. The reason being is because this strategy is a lot more difficult, a lot more in-depth, and I'd like to go into all of the intricate parts of the trading strategy so that everything can be understood. I'm also learning as I go along, so I'm trying to get the best of understanding of this trading strategy because I believe that it will be the trading strategy that I will be using day in, day out. So what is the trading strategy? It is a smart money trading strategy that works on structure. It also works on the wyckoff method, but also has other variants which we'll be looking at also along the way. Structure plays a humongous part inside this trading strategy, and understanding how smart money, so the institutions and the whales, if you will, all of those kind of big boys in the group are actually manipulating the market to send money in the direction where they want. So I guess the best thing is to get to my computer. We're going to be discussing structure today. So first thing is going to be the structure. I'm also going to go through a high-end overview of multiple parts of the order blocks and things like that inside of the strategy, so that we can understand the things together. And then I will go into more detail over next Monday and next Friday, more detail into the actual trading strategy itself. Here's the plug. It will be on TradingView. I will be coding it, and you will be able to find the links down in the description below. So if you are interested in following me, let's get over. Let's have a look at the first parts of this trading strategy. Right, let's go. Okay, here we are on my computer, and the first part of this, I'm going to give credit where credit is due as always. The actual trading strategy was inspired by this guy, which is MintFX. Great YouTube channel, lots of wonderful information about the MintFX trading strategy. Today we're going to be going through it. We're going to be going step by step through all of the parts of the trading strategy over the next couple of days, and I'll be coding it as I go along to get the best possible results. So I do suggest you go and have a look. Before I go any further, I'd like to say be very, very careful of the spammers in the comments. I have realized that the last couple of weeks there's been more and more as the channel has been growing. So be very careful. I will never contact you via WhatsApp or ask for your WhatsApp. I will never ask for any investments, and I will never ask for your money. Just thought I'd go through that very, very careful. So we're going to be looking at structure first of all, why the market makes these highs and lows. We're going to be looking at trend lines and why they're not as good as they're made out to be. Things like highs and lows, head and shoulders patterns, all of those kind of things that we as retailers, dumb money, yep, that's what they call us, are actually creating, and they are being faked out all over the place and you're losing money. And then part two will be order blocks, which we'll look at further down the line. Okay, let's get back over to the computer. Okay, so a good important part about this, you can't see this because I'm over, let me go over here. Right, okay, an important part of this is the composite man. Now this is a wyckoff theory. The composite man is the man that has the most amount of money inside the market, meaning institution, big banks, and aka whales in the crypto world. Manipulation is made by these whales, by these institutions, to push money in the direction where they want to go, using liquidity to fetch liquidity in the market, and to liquidate us, to take our money, to take our positions in the opposite direction. These patterns happen all over. We all know that the markets are fractal, so they're happening on 1 minute time frames to 1 hour time frames, to 4 hours, to dailies. Each and every one of these markets, each and every one of these time frames are acting in the same way, but in different ways at the same time. We're looking at the retail fake outs and why the fake outs happen, and what these patterns are for, grabbing your liquidity, so they're liquidating your stop losses, and also taking, like I said, the money in the opposite direction. So let's go over to a chart very quickly here. Let's hide these indicators very quickly. So now we know that the composite man is not on your side. He is certainly not going there to help you make money. He's after all of your liquidity. We need to work in the same way that he is, so we can follow his game and make money at the same time. Okay, let's have a look at this example here very quickly. Just an example of how I would trade, or dumb money, or whatever you like to call it, would trade. We see this kind of pattern here all the time, where we've actually come into a bullish area, expecting prices to get high. Everybody's getting extremely excited. We're creating higher lows, continuing along, hopefully for more upside. Obviously, the institution wants to take advantage of our money, take out as many people as they possibly can as they go along. So they're going to create consolidation areas. They're going to create areas of patterns, institution patterns, triangles, bull flags, all of those kind of things as they go along, so that they can take out our liquidity as we're going along. So you would have been right to have seen these patterns here, which would have been great. And then we start going along and we start seeing a little bit of a consolidation area, still above this low here. But we would have started seeing things like this. So the market starts moving against us. We've taken out this low here, which would have had probably a lot of orders from even the institutions in this area here. But it's something that they're willing to come back and pick up later. Now we'll be looking at order blocks afterwards, and why this would have moved back down here. But yeah, so this area here, potentially as traders, we would have started drawing lines like this here, where we would have seen that there is a breakout here, expecting a breakout. We would have got in maybe just here with a entry for a long, as we're expecting price to continue this pattern up towards this to the moon, and it actually completely worked against us. We lost our entries as longs. They were stopped out here, and we would come down into this short zone here. This creating this pattern here, or which could have been around here, or even lower, creating a channel, maybe a channel up here, which we would have got into as a short, maybe, as we broke that pattern. So we could have got in a couple of entries here if we were lucky and we were keeping an eye on the charts. Got in a good old entry just here on this mark here, where we would have seen that we would have seen that we could have got a short here. We're breaking this lower channel. We could have got a short just in here, hopefully, which would have moved up and down, maybe liquidated a couple of people, taken out stops here, and then maybe even as we're breaking back up, we could have had another long in there, expecting as the retest over here. We're taking out more long shorts here, and we get our actual entry here before it even dumps even lower. We would have expected this to go up like this. It didn't. It just worked again and faked out once again here, creating another breakout where we would have maybe got another long in short just in here. So that's how many positions. I have no idea that we would have been stopped out on here. One here, at least one here, a couple around this area here. We would have longed here, gotten stopped out as it would have come against us here. We would have shorted here, and being the greedy dumb money that I am, I would have not in the slightest taken profit here, expecting it to come all the way down to where it was, and completely reversing against us. I would have kept my positions in just around here, continually waiting for profit and money bags to roll in as I'm going along. And yep, you guessed it, this would have bounced around, taking out a lot of positions, creating patterns all over the place here that dumb money would be drawing all over the place here. Some patterns. It breaks out that pattern there, going against my short that I had just here. So we've lost any stop losses that were here have been taken out now. Any longs would have the longs for here would have been fine, leaving some money on the table here. The institutions making lots of patterns we find in textbooks, from W's to supports and resistance, breakouts, fake outs. Everything that you would have seen in textbooks would have been in these patterns here, as they start rebuilding up into a bullish pattern once again, taking out any shorts from above here, taking out any shorts from above here, taking out anything all the way. How many positions would they have liquidated? Would have been absolutely incredible before pushing back completely up to the upside and continuing the same pattern that they were in before, getting us stopped out left, right and center. And when you actually look at the bigger picture, the picture of the institutions, the only important things here was where they've put in their money in the lows, protecting the lows, and never coming below these lows, except for this one here, where there would have been an order block, which we would have seen. They would have come back and tested that order block, come back down to take out that order, and then they would have come back up above that order to go to highs. So I've been working on these patterns, these pivot patterns here, which is the first part of this actual trading strategy. So the idea is, as I was saying, we're actually creating these lows here, 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 and we're never actually taking those lows out. We go through consolidation areas where we actually create order blocks, but they actually never ever come and go lower than these predicted areas. And then we actually come down after that. We come down and we actually create a low, our first set of lower highs here, which you can see here. Lower lows, lower lows, lower lows, another consolidation area to come and get some more liquidity out the market before creating even lower lows. And then we're dumping all the way down here. We're creating also the lower highs as we go along here, always creating and protecting their positions up here, because this is where they're actually selling off. So yeah, as I was saying, these are ways of them protecting themselves against the market, and also liquidating and creating liquidity in the market. Liquidity is just literally orders in the market that they come away, and obviously they take in the other direction. Right, now we know how not to trade, and how that the actual institutions are looking at the market slightly different to us, and how the liquidity is created, and how that they are fetching the liquidity in the market by trapping us into fake outs and breakouts. Now what we're going to do is try and look at where we could get entries in the same sort of patterns using order blocks. Now order blocks are created when the institutions are ordering in the opposite direction, creating a candle in the opposite color, and then an engulfing candle will be made to push that market in the other direction. So they're orders that the institutions will have to come back and pick up later before actually pushing the market higher or pushing it lower. So let's have a look at these order blocks, how they're created using engulfing patterns for a bit more confluence, so that we are sure of the entries that we're going to be taking. There is multi-time frame ways of looking at this, and much more complex ways of looking at this. I'm going to go into the very simple ones today, and then I'll look in more detail into multi-time frames, and also adding things like wyckoff and a couple of other patterns to improve on our entries and make sure that we're taking the best entries possible. Okay, to understand order blocks, you have to understand the liquidity, which we were talking about a minute ago. The market orders at the tops and the bottoms of all pivots here. I've got a pivot script that I created over here. Helps us to find where the most liquidity is in the market. If you go over to the beginning over here where we were, all these red lines and green lines are indicating where orders could have lied and haven't actually been taken out by the banks or by the institutions, etc. So in the markets, there are what we're looking for to try and get onto the same wavelength as these institutions, etc. are inefficiencies in the market. Now, inefficiencies come in different forms. And are created by things like after a drop, we have a couple of large candles here. For instance, here would be an inefficiency. If I could just draw this one here. Between here, I would say here and here would be an inefficiency where candles go up and create a lot of bullish pressure, and we actually come back down and fill those candles where the low of the top candle does not actually meet the high of the candle, the previous candle here. As you can see, there's a lot of space between the two here, a gap, and that gap is actually met by refilling as we go along. As a strategy developer, this is the kind of thing that we should be looking for. Things like inefficiencies in the marketplaces where candles actually don't meet between the two, and we come back and fill them in a later date. Gives us perfect entries for finding, because we know that these are like magnets. These inefficiencies are like magnets to the market. We know that they're going to come back and visit them later. You can see one just here. If we go over here, we click this one here, you can see that none of this here there was a big gap around this area here, and we knew that the market would go up and come back and fill that gap here and fill it even more just here. So we had our gap filled on those two on that area there. So that is one way of looking at inefficiencies and ways of entering the market. We will look at that as we build our strategy. Another one is the order blocks. So order blocks are displayed as these blocks, red and green blocks inside of the indicator that I'm creating, and they are actually created by a engulfing pattern here. This engulfing candle that is engulfing a previous green candles. So when we're in a uptrend, the last green candle is considered where the order block would be made, and that is confirmed by a red candle moving into a bearish zone. So for instance, here we have one which is absolutely perfect. We are engulfing the candle here. We have a block that has been made. Now these are actually made very much in the same sort of way as one of my favorite patterns, which would be an ABC. Very much small, very small patterns here. They are actually where you can imagine banks are actually coming into the market, institutions, and they're wishing to grab all the liquidity from up above here. All of these stop losses, etc., all above here, they're wishing to collect before pushing the market further down. Now that creates a order block, this red block here, and like I said with the inefficiencies earlier, they work a bit like magnets. The banks, institutions have to come back to these zones to come and pick up the money they've left behind, because they've actually had to push the market up to get the liquidity from here before pushing it down at a lightning speed. So that has created these inefficiencies here, which have orders left over, which we call order blocks. So now let's go and have a look at a recent example of an order block and how it would have worked. As you can see here, we have our banks coming in at this area here. They have pushed the price up to get all the liquidity out above this previous candle here. A engulfing pattern, so where they push price right down, leaving orders here that they will go and fetch before re-pushing price back down. Once we come and mitigate and to touch the order area, the order block here, we actually expect either price to push back up or push back down in the back as before. So this happens quite often in the market. As you can see, there's quite a few of them. Very fractal. You have to keep an eye on all time frames while doing this, because of the way that the market works. Something that could be an order block on a 4 hour, could be a smaller block on a 1 hour, and could be mitigated on a lower time frame. So you have to look at all of those kind of things. They're kind of things that I'm going to have to work out how to code as I go along. I will go into a better explanation of how these order blocks are actually created in a later date. And whilst I'm creating strategies, what I'll do is I'll backtest as many kinds of strategies and algorithms as possible to find the best entries thanks to these order blocks. I'll also be doing the inefficiencies. They're in there as well. You can hardly see them. They're the yellow blocks just here. There's one here. I believe there's 1 and 2 just there. As you can see, there's quite a few of them all over the place. These are inefficiencies strategies in the market where price will move back and fill. As you can see, there's just one here, I believe, where bearish pressure was so high that we've actually had to come back and fill that here. So that would have been a absolutely perfect entry as well, or confluence for our entries. So to summarize very quickly, as I said, these order blocks, which is going to be the bread and butter of this this strategy, are made out of banks or institution manipulation, whales, whatever you want to call it, are pushing price up to grab liquidity above that price, and then push price down at lightning speeds, leaving orders behind that they have to come and collect, as you can see a bit later. And then they push price either back in the same direction or against the trend, depending on what trend that they are pushing the market towards. Anyway guys, I hope you enjoyed that. I hope that it helps you to understand how institutions are actually trading, smart money, dumb money, that kind of thing. I will be diving a lot deeper into this one and be building a trading strategy, hopefully for multiple platforms, so that we can find confluence maybe in Python or just in TradingView, adding more and more confluence to this trading strategy. Looking for exits and entries, stop losses, how to set those kind of things. And I'm going to be looking at that through code. I'm going to be coding the strategy so that everybody can add this to their trading view and trade hopefully with bots in the future. Apparently 75% of all American trades are now made by algorithms. So a lot of this is already done by the institutions on algorithms. So that's something that I want to implement a lot more into my trading strategies, is this kind of trading strategy here. It helps me to also understand why I've been trading those ABC patterns for so long. As you can see, thanks to the wyckoff patterns and things like that, you can actually see why those ABCs are actually forming. And the great thing is hopefully we'll be able to get less trapped by some of these fake outs before actually that ABC shooting off to the moon. Anyway guys, I hope you enjoyed. As I said, if you did, please don't forget to give it a good old thumbs up, and don't forget to subscribe. I will continue this kind of trading strategy throughout the next couple of days, and I'll add a couple of other trading strategies in between, just in case this isn't the one that you're looking for. Have a great day, have a great weekend. I will see you on Monday. Take care, keep safe, and have a good one. Goodbye.
Again, he's gone to code a new strategy. He'll be back in just 5 minutes. RSI and MACD. If he doesn't run into any bugs, there will be a new strategy.